Thanks, Carl. There were some interesting tax and benefit announcements yesterday, and what I'm mostly going to do for the next few minutes is talk you through some of the more interesting ones. But the bigger picture, as Paul mentioned, was that actually this was a relatively quiet autumn statement in terms of measures announced. Now, if that's an indication of less hyperactive fiscal policy in future, I think that would be welcome. As Paul mentioned, we've had many years now of really too many announcements being made, not very well thought through. And I think one area you can see evidence of that is how many measures have been announced that have then needed to be unannounced later. So I'll start off just by running through a few of the more interesting cases where an announcement since the last budget has now been, an announcement has been reversed since the last budget. So cuts to the personal independence payments for some recipients of that disability benefit were famously abandoned only a few days after they were announced in the March budget. A plan announced in the budget last year to allow pensioners already receiving their pension to sell that stream of annuity income has been abandoned as there appeared to be no market for it. A plan to increase rents for local authority and housing association tenants with relatively high incomes that was due to come in next year was abandoned. And finally, yesterday, we found out what was happening with the so-called Shares for Rights scheme. So this is something that 4 years ago, then Chancellor Osborne announced that employees would be able to get favourable tax treatment on shares in the companies they worked for in exchange for giving up some employment rights. The government then made that scheme even more tax favoured. It has now discovered shockingly that this is being used as a way to avoid tax. And so it's getting rid of that possibility. So moving from things that have been unannounced to things that might be announced, something that, as far as I can see, wasn't mentioned in the autumn statement document itself, but was mentioned in the Chancellor's speech yesterday, was highlighting the OBR's increasing concern about revenue loss from people changing the legal form in which they do business. And the Chancellor suggested that he might in future come up with proposals for consultation. So what's the issue here? If you take an example case, suppose I can provide services that people are willing to pay £40,000 for. I could do that either by being employed by them, or by being self-employed and taking on the business that way, or by setting up a company and having the company provide my services. Now, which of those I do will have an effect on which taxes I'm liable for, and therefore the total tax liability. So again, this is just one example that illustrates that being self-employed is more tax favoured than being an employee, and setting up an owner-managed company is more tax favoured still. Basically, the biggest reason for this difference is the different national insurance treatment of those different forms. And the differentials between these have gone up and down. Actually, the advantage of being a company rather than self-employed is rather lower now than it's been for most of in recent years. Although to some extent this chart understates the advantage, because setting up a company allows you also to do other things like sharing some of the income with a spouse or shifting it between years and so on, which can also help to reduce your tax bill. I'm also assuming here that you get all the income straight away. Again, if you can take some of it as capital gains, it could be even more tax favoured. But so much for the issue. Clearly, looking at this, the obvious solution to it is not to mess around with the sets of rules that define the criteria for falling into these categories, but simply to align the tax rates, the effective tax rates, taking all of the different taxes into account, that you pay depending on legal form. Now, on its own, that, I mean, as well as the obvious political difficulties of announcing something like that, on its own that might have problems because business income is not necessarily reflecting just things that you could have done as an employee. It may, for example, reflect returns to capital that you've invested in the business. As Paul said, we gave this a lot of thought, and the Merley's Review proposes a systematic reform to not only align tax rates, but also deal with the tax base to really try and line up everything in the best way you can. Now, the OBR has become increasingly concerned with these differentials because we have seen increasing numbers of people setting up companies in recent years. There's also been increasing numbers of people combining employment with self-employment as well. And this has been highlighted recently by questions about whether, for example, Uber drivers should count as employees or not and be taxed accordingly. And we'll be addressing this in, not Uber specifically, but this issue in more detail in our green budget. So come back in early February for more on this. So this is where they might do something. The Chancellor did yesterday say he definitely would do something to, as he described it, equalise treatment in another area, and that is salary sacrifice. So a salary sacrifice is essentially an agreement whereby I agree to take a lower salary in return for some other perk that my employer offers me instead. And essentially, if the perk is taxed less heavily than a cash salary would be, then there's a tax saving from doing that. Mr. Hammond announced yesterday that he intends to tax these salary sacrifice arrangements more heavily in certain cases, I won't go through the details, that would raise about £0.3 billion a year. But he omitted easily the biggest case where salary sacrifice is used, pensions, along with some others. He explicitly said he didn't want to reduce the biggest tax advantage that most benefits in kind get, which is an exemption from employee national insurance contributions. And this is only being applied where there is an explicit agreement to take a lower salary in exchange for the perk in question. And you can imagine lots of other cases where implicitly I might be getting a perk instead of some salary I might otherwise have got, which suggests that we're going to get lots of problems at that boundary, potential complexity, unfairness between people who are really being remunerated to the same extent but through slightly different processes. And it rather begs the question of, again, why not just go for the straightforward solution of taxing these perks at the same rate that we tax ordinary salary? It doesn't solve all the problems. You'd still need to define what exactly constitutes a perk, a benefit in kind. But it would seem to be both simpler and fairer to do it that way. And that is in fact something that the Office for Tax Simplification suggested when they reviewed this area of tax law recently. So turning from direct to indirect taxes, insurance premium tax is something that tends to go under the radar. The Chancellor yesterday announced that the main rate would increase from 10% to 12% next year, raising a bit under £1 billion. But that's the third increase that's been announced just since last year's election. The main rate has doubled. And this is following on from, as you can see, a long history of increasing rates of this tax since it was introduced in the 90s. So it's worth delving a little bit more into what this tax is doing. So the starting point is to realise that essentially insurance is exempt from VAT. An insurance premium tax was introduced in the 90s, essentially intended to try and substitute for VAT. Now, what you would ideally want to do to get as close as possible to a VAT is tax the insurance premiums less the payouts that insurance companies make when a successful claim is made at the main VAT rate. And if your weekends are not exciting enough, there is an entire chapter of the Merrill's Review explaining exactly how this can be done. What insurance premium tax does is simply to tax the insurance premium without these deductions. And if you're going to do that, the appropriate rate is much lower than the VAT rate. Actually, it's simply you want to take a percentage of the VAT rate that is the amount of value added as a percentage of the total premiums. And if you're going to do that, a rate that's essentially 60% of the main VAT rate looks too high for final consumers. But actually what I want to emphasise, and where the real problem lies, is in insurance bought by business customers. Now, business use of insurance ought to be completely untaxed. And one of the basic principles in the economics of taxation is you don't tax intermediate inputs to production. This is why with VAT, we allow firms to reclaim the VAT that's been charged on their inputs. We don't just tax them on their turnover. With the insurance premium tax, there's no deduction and there's no reclaim. And that means that economic activity in the UK as a whole is skewed away from production of goods and services that requires insurance as a way of producing it. And that just seems a very funny bias to introduce in the system. Now, this is not a new problem with insurance premium tax, but it is a problem that you might worry rather less about when the tax rate is 2.5%. At a tax rate of 12%, this is becoming a tax that we need to worry about really quite a lot. The other big indirect tax announcement yesterday was on fuel duty. Now, the OBR, in rather understated way, suggested that the possibility that the actual path of fuel duty rates policy in future will differ from currently stated policy is a risk that we consider worth noting. To suggest why this is worth noting, this line shows what's happened to fuel duty in real terms over the last few years. If you compare that with this is fuel duty policy that the coalition government inherited from Labour in 2010, and we can now see how stated policy has evolved at each subsequent fiscal statement. So as of yesterday morning, this green line was official policy. The autumn statement said that there would be another freeze next April at, again, a cost of about £850 million. The current policy is still that after April 2017, it will start being uprated in line with the retail prices index again. But if you think that the recent trend of freezes will continue, what you might expect in real terms is something more like that. We're seeing really quite substantial erosion of fuel duty as a revenue source for the government. So this will now be 7 years that we've had without fuel duty even keeping pace with inflation. That's a 13% real terms reduction, costing the government about £3.5 billion a year. Most of which, if you're worried about just about managing families, in fact goes to the better off half of households. Now, if you really thought that a perpetual freeze to fuel duty is the right policy, then the government should just say so rather than producing this as an exciting new giveaway in every fiscal event. Perhaps even stranger was the reason given yesterday in Mr. Hammond's speech for freezing fuel duty again, which is the oil price rise we've seen recently. I don't remember when the oil price plummeted a few years ago, a corresponding hike in fuel duty rates. But in any case, oil prices don't bear very much relation to the basic social harms from motoring that fuel duty is supposed to be there to correct in terms of emissions and congestion. And so it's not clear why the oil price should have a big part in the rate of fuel duty. On the benefits side, the big announcement yesterday was a change to universal credit. So for anyone who doesn't know, universal credit is a new means-tested benefit that's in the process of being introduced to replace 6 major means-tested benefits and tax credits for people of working age that were there before. The easiest way to explain it is just to look at an example. This is fairly arbitrarily chosen, a lone parent with 2 children earning the national living wage. So there's a maximum entitlement that you get if you have no other income, 15,000 and something pounds a year for this particular person, though of course it depends on circumstances. There is a work allowance, which is the amount you can earn before your universal credit starts to be means tested away, but above that work allowance, your universal credit gets gradually withdrawn. Now, last year, Chancellor Osborne announced a significant reduction in work allowances, which essentially means reducing entitlement for pretty much all in-work universal credit claimants, about 3 million families. What was announced yesterday didn't change the work allowance itself, but said that earnings above the work allowance will now reduce your entitlement slightly less quickly. So you will lose only 63p of universal credit for each pound of net earnings rather than 65. And you can just about see that that partly compensates families from the cut in the work allowance. It's a little bit difficult to see what's going on, which is a reminder that none of these changes are, doubling or halving people's entitlements to universal credit. We're talking about changes in the amount you can get. But if we zoom in and focus just on the differences between these lines, what you see is that, as I mentioned, the work allowance cut, broadly speaking, takes the same amount, 500 and something pounds, from almost all working claimants of universal credit. Yesterday's change gives back almost none of that if you're only just above the work allowance, but the more you earn above that, the more you benefit from being able to keep an extra bit of each additional pound. Now, how much that compensates any particular family for the cut in work allowances will depend not only on their hours of work, but also on various other circumstances. But as an indication of overall magnitudes, the cut in work allowances the government thought would cost something over £3 billion a year in the long run, once universal credit's fully rolled out and so on. The compensation, if you like, the change announced yesterday, gives back something over 0.7 billion pounds of that. Now, talking about these changes to universal credit still to me feels somewhat abstract and theoretical, because this is a policy that is not yet fully in place. And it's worth remembering that since universal credit's introduction was announced early on in the coalition government's term of office, we've already seen 4 changes to work allowance, 1 change to childcare support, and this latest change to the withdrawal rate, all before the policy has fully been implemented. In addition, the implementation of the policy itself has been something of a mess, with the planned date at which the rollout of the policy will be complete delayed by 4 years in the past 3.5 years. It's now planned to be complete by March 2022, although the OBR, looking at the history of rollout plans to date, is building in an assumption that there'll be a further 6-month delay. But while the policy rollout has started and not finished, we should remember that they still actually haven't decided everything about how the policy is going to be designed. So in particular, we still don't know which families are going to be entitled to benefits in kind like free school meals. So we have a policy that's halfway through being rolled out, and the government is changing the policy, and in some areas still hasn't decided quite what it wants the policy to be. So finally, I know it wouldn't be an IFS event without a decile chart. So this just shows in a fairly standard way the distributional effect by income of tax and benefit reforms due to be implemented during this Parliament. So we divide the population into 10 groups based on their net income, poorest on the left, richest on the right. And this is the effect of policies announced before yesterday's autumn statement, adding in the autumn, the big autumn statement announcements, the last three I talked about on universal credit, fuel duties and insurance premium tax, makes essentially no difference to it. So if we add the big bars and the little bars together, the basic picture is still unchanged, that the big losers from tax and benefit reforms over this Parliament are due to be low-income families, largely through the £12 billion of welfare cuts. And the picture looks pretty much the same if you take it as a percentage of income rather than in cash terms. So, again, what this highlights is that this was a quiet autumn statement. None of the measures that I've been talking about even amount to £1 billion a year, which is kind of not a bad benchmark for is this a big policy. Generally, that is a good thing. Stability in the tax and benefit system is desirable. Fewer and better thought out policies would be a good direction of travel if it could be sustained. What we have seen, small giveaways to motorists, continuing recent trends, and to low-income working families, somewhat reversing the recent trend on universal credit reforms. We've seen another increase in the rather badly designed tax we've got on insurance. We've seen a clampdown on salary sacrifice that's rather missed the bigger opportunity to rationalise the system that was available. And finally, we've seen a renewed focus, if not yet actual policy proposals, on one particularly problematic area of the tax system in terms of the legal form in which people do business, and look forward to hearing from and possibly engaging with the government more on that as they give it more thought. For now, I'll pass on to Andy to talk about living standards.